Okay, good morning, and thank you for joining us for today's webinar. My name is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank of New York. Today, we're fortunate to be joined by Kristina Hooper, Chief Global Marketing Strategist for Invesco, who will provide us with an investment outlook for the year. But before we turn it over to Kristina, just three quick updates for our FHLBNY members. First, on the advanced side, we made a couple changes to our advanced rebate program. In response to you, our members' interest in prepaying and or restructuring liabilities has increased. So we've made an enhancement to the rebate program, which provides members an opportunity to receive cash rebates when prepaying eligible advances and rebooking them with new advances within a 30-day period. On the community investment side, we made a few enhancements for you as well. Later this month, we plan to launch our new system for the Affordable Housing Grant Program, which is an online portal for our AHP General Fund and a key part of our continuing effort to strengthen online capabilities to better serve you and our housing partners. The new portal will streamline the submission of applications and other document requests while also providing you with a centralized location to view the entire project portfolio. And speaking of housing programs, this month our community investment team is holding virtual sessions for our 2022 AHP round and other housing program, the Homebuyer Dream Program round. For more information and dates, contact your calling officer, and it's also on our website. And finally, on the secondary market side with MAP, we continue to onboard our members on our new mortgage asset program for a much improved secondary market outlet and experience for you. The MAP program is gaining traction with members, mainly because of the competitive pricing with no loan level price adjustments, a big topic at the agencies right now. Also an avenue for you to accumulate high-yielding FHLBNY stock and strong support staff and state-of-the-art technology. So again, please contact your calling officer if you'd like to have a one-on-one session or check it out on our website. So let's jump right into today's webinar. Just a couple of quick details for you. If you have any questions during the webinar, please submit them at any time through our question box, and they will be answered at the end of the session. We ask that you complete our survey on the topics and speakers we select for these sessions come directly from you, so your feedback is very important to us as we put together our webinar program for the remaining part of the year. And now I'd like to hand it off to Tom Citino, our Director of Member Relations, to introduce our special guest. Tom?
Hey, Adam, thank you very much. Good morning, everyone. It's really a pleasure to introduce Kristina, who's the Chief Global Market Strategist with Invesco. I think you're really going to appreciate some of Kristina's insights. We're heading into a new point in the interest rate cycle, or maybe into a new interest rate cycle. People are wondering what loan demand is going to do this year, and maybe focus on building their investment portfolios. So I think this is a very timely message that Kristina is going to be bringing to you. But just a little background on Kristina, Chief Global Market Strategist at Invesco. She leads a team that's on the ground in North America, Europe, and Asia. Her and her team formulate macro views of the markets and the economy and examine the investment implications of those views and share those insights with clients and the media around the world. So prior to a little background on Kristina, prior to joining Invesco, she had been the U.S. investment strategist at Alliance Global. And then prior to that, Kristina has held positions at PIMCO Funds, UBS with the former Payne Weber, and MetLife, who's a member of ours today. Kristina is also actively quoted in many of the financial journals, Wall Street Journal, Financial Times, New York Times, Reuters, and other financial news publications as well. And then she's also she regularly appears on TV, CNBC, Bloomberg TV, and other outlets. So with that, it's really a pleasure, Kristina. I'm going to turn it over to you now.
Thank you so much, Tom, Adam, for having me. Thank you all for being on. It's really a pleasure. And hopefully this can be fun and somewhat helpful and illuminating, and I will promise to leave enough time at the end for questions. I look forward to hearing from you. So let me start. If you can turn to the next slide, this will give you a sense of our agenda for our time together. what we're going to do is really talk about where we are in the cycle in the United States. And certainly in the context also, we can talk about where we are with the world, the direction of the economy from here. And of course, a lot of that has to do with policy and in particular monetary policy. So we'll spend some time on that. Then we'll talk a little bit about the risks to our outlook. And of course, as you can imagine, they really center on inflation. And then finally, of course, what are the asset class implications? What do we do with this outlook? So if you turn to the next slide, and actually 2 slides after that, we'll go through there's nothing on the next 2 except next on a pretty picture, and take you to where we are in the cycle. Now, I find this chart really helpful, not because I'm giving you any information you don't know, but I think it's really helpful to put it into context. What we have here is the last, essentially 5 business cycles. And just a few key takeaways from this slide. First of all, it's incredible to think about how deep the contraction was for the economy during the pandemic, and also how quickly it rebounded. It is very much a V-shaped recovery in its early stages. Now, a few other takeaways from this chart. The business cycles that we've seen in recent decades have been quite elongated. We've been able to essentially have that delicate balance where we've had enough policy support to continue that economic cycle for a long time, not too much in the way of tightening to actually end that cycle, especially post-global financial crisis, as we know. I would argue that it is very, very possible that we can see this cycle continue for some time. I know that we're in a precarious place right now. That essentially the Fed has a very delicate balancing act because inflation is significantly higher than in past tightening cycles. And so it's going to be harder to negotiate a soft landing. But I do believe that we can do that. In fact, I think that's more likely than not. And that we could have significant legs. Certainly, we're going to see the economy decelerate. We should see it. It's at unsustainable levels. We will decelerate towards trend in the U.S., but that does not mean the end of the cycle. In fact, if you look at the last 5 U.S. business cycles, the average has been 8+ years. And they produced on average a cumulative 25% growth in U.S. real GDP. So where we are now, we're only at about 1.5 years or so, as we know. Well, getting closer to 2. But this is, there, and this is a result of the kind of dramatic stimulus we threw at the economy, which we didn't throw at the global financial crisis. We were really lacking in terms of fiscal stimulus. But I do believe that as we withdraw stimulus, there can be negotiated a slowdown that does not end in recession. So if you turn to the next slide, what is the case for not seeing this end in recession? And really, there are a few things we want to look at in terms of leverage, what exactly is going to happen with policy this year, and of course, lending. So if you turn to the next slide, what we're seeing in general is a good picture in terms of leverage. Cycles tend to culminate as corporate leverage builds and lending standards tighten. And, currently what we're seeing is corporate leverage as a percentage of the market value of corporate equities actually stands near a historically low level. And lending standards are relatively easy. So this does not suggest that we are anywhere near the end of the cycle. And in fact, that again, that this economy can withstand Fed tightening. But let's turn to what we called our end of cycle dashboard on the next slide. And we look at a few different components that tend to be signals that the business cycle is coming to an end. One, of course, is inflation is high and rising, and we do have to check the box there. There's no mistaking that. But I would argue that we're likely to see inflation moderate this year, that we will see the peak. I'll get into that more a little later in the presentation, but clearly that is the catalyst for the Fed making its hawkish pivot. And so we can't ignore it. So I don't want to minimize it, but if we look at other elements of the dashboard, they're far more positive. So if we look at the high yield spread, typically high yield spreads widen very significantly when we're getting towards the end of the cycle. Dollar strengthens quite dramatically. We certainly haven't seen that this year. We anticipate the dollar will remain relatively neutral. So much of the indicators that we're seeing right now are not suggesting that we're end of cycle. Obviously, we want to pay very close attention to all these indicators, especially in a year when tightening begins, because the risks are higher. But I think we also have to recognize, if you turn to the next slide, that for most components of the business cycle, that stocks tend to outperform bonds. Now, there is a lot more volatility typically with stocks, but this is an environment in which, except for the slowdown phase where we tend to see a convergence of asset classes, over the full cycle, stocks outperform bonds. But the caveat is that we are entering that slowdown phase of the cycle where we are going to see a convergence of asset classes. So I'll get to that in the implications component. But just to have take a step back and have some perspective on it, I thought it was important to share this slide. So if you turn to the next section, right, what's the direction of the economy from here? Well, as I gave away, spoiler alert, we are moving from expansion to slowdown. And if you turn to the next, actually, if you forward ahead another slide, what you'll see is that the economy has been very strong. It's undeniable, right? What we've seen is very adequate fiscal stimulus, and so coming out of the pandemic, even in the pandemic, we saw very elevated household savings that helped propel sales. They were focused on goods as opposed to services because of the nature of this crisis, being in a pandemic. But we certainly saw improvement, and I think it's very interesting to see, where we are relative to where we were pre-pandemic. And actually, when it comes to consumption, when it comes to housing, when it comes to business investment, and when it comes to employment, we're in a better place than we were pre-pandemic. And I think that while this is certainly a very good place to be, it also has given the Fed more confidence in making statements about tightening this year. And in particular, I believe that is a main reason why we're seeing the Fed so comfortable with reducing the size of its balance sheet so early in the tightening process. Now, we don't have a lot of historical precedent. This has only happened once before, but quantitative tightening happened several years after tightening began. And that's a big difference this time around, that the Fed essentially will begin it probably this summer. And I believe that a lot of that is a much greater confidence in the strength of this economy, as borne out in some of the statistics you're seeing here. So if you turn to the next slide, we do anticipate a slowdown. I talked about that elevated household savings. Well, we've burned through a lot of that. We've spent a lot, and there are some who didn't return to work. They wanted to be more selective, and I think that's also been a contributing factor in the drop in household savings. Of course, other indicators suggest that we are likely to enter a slowdown as well, including the withdrawal of fiscal stimulus. Expectations are for less stimulus, and that is a good thing in this environment, given that inflation is running hot. Fiscal stimulus is, in my opinion, a bigger contributor than monetary stimulus to some of the elements of inflation that we're seeing right now. So if you turn to the next slide, well, we put this chart together. This is as of December 31st, but in fact, the same title applies now, in that financial conditions have tightened a bit, but still relatively attractive. So this is what the Fed is essentially attempting to engineer, right? Is that tightening without being too tight, and we're seeing that happening now. So again, that points to a deceleration in the economy, that we're going to see economic growth get down closer to trend. And that's a good thing coming from what I would argue is our unsustainable levels that, of course, are helping contribute to inflation. So again, it's all about being able to negotiate that soft landing. So if we turn to the next section, that's about the policy implications. And I covered fiscal stimulus. I don't think there's much to be said, except that, of course, we're going to see a reduction in stimulus. There's not going to be a lot of success in legislation in Congress, let's face it. But that's probably a good thing, given that we've seen so much stimulus. I mean, if we look at stimulus as a percentage of GDP in the U.S. and other developed countries, it was so much higher this time around as opposed to what we got in the global financial crisis. And that's why we had such a markedly different recovery, I would argue. In the global financial crisis, it was rather anemic, especially when it came to jobs. And this has been a very different kind of recovery. So if you turn to the next slide, oh, actually, the one after that, all these pretty pictures that are meaningless. So if you look at this, the Fed is clearly concerned about inflation. Although, interestingly, I think markets have thus far responded relatively positively to the Fed's hawkish pivot. So these break-evens were done several weeks ago, and in fact, they've come down a little bit since then. The 5-year is down a little. The 3-year, the 10-year and the 5-year are down a little since then. So I think there's still confidence that the Fed is going to be able to bring down inflation, or at least some components of inflation. And really, at the end of the day, that's what, in my opinion, the Fed is going to rely a lot on, is its words. Now, I know that my opinion is very much in the minority. We've got estimates out there that there are going to be 8 rate hikes this year. I'm rather skeptical of that. I do believe the Fed is going to be data dependent. I think that's one of the key takeaways that we got from the press conference last week with Jay Powell. But the fact that the Fed is employing quantitative tightening so early in the cycle suggests to me that it can lean on QT more. And keep in mind, from the Fed's perspective, it would rather put a damper on Wall Street than on Main Street. So the idea that it can attempt to tighten via balance sheet reduction suggests that it doesn't have as much pressure on it to raise rates as much. So I still think it's very, very possible that we see only 3 to 4 rate hikes this year. Again, that is a minority view at this point. But I do believe the Fed has already had some success with hawkish words, and I do believe it's going to rely on QT to do some of the work this year. So this should be a less hawkish environment than many expect. Now, of course, you can have me back at the end of the year and yell at me if I'm wrong, but this is my anticipation. Again, a lot of it is going to be data dependent, but I do believe the Fed also recognizes that there's some inflation it can't solve for with monetary policy, and it doesn't want to choke off this economic cycle. So again, a delicate balancing act. We'll see where it goes, but that's my call on that. So let's move on from monetary policy and get to the outlook and the risks to the outlook. And I alluded to this a little bit. If you turn to the next slide, so much of our outlook this year has really been dependent upon inflation. Now, if I had come and spoken to you at the start of last year, I would have told you that we were still very concerned about the pandemic. And so that was one of our tail risks. But this year, it's really all about inflation. Certainly, a pandemic resurgence is a potential risk, but I don't see that as nearly as concerning as high persistent inflation. And so that is why our outlook essentially is shaped by inflation. And so in our base case, our anticipation is that inflation peaks in the middle of 2022 and cools gradually. And I mean gradually, because there are elements of it that are going to be stickier that I'll get into in a minute, but that we probably get close to target by the end of 2023. And I do believe that there are real disinflationary pressures over the longer term, like innovation. So inflation is a problem right now, but not over the longer term. So we see developed market central banks essentially not getting too hawkish, but being hawkish enough to combat inflation. Now, for those of you who were looking at the news in between your meetings this morning, you may have seen that Madame Lagarde took a hawkish turn. I do think she's following Jay Powell's playbook, in that words are cheaper than actions. Again, we'll see if that's correct, but I believe that will be the case with the ECB, especially given what it's lived through in the past decade in terms of perhaps overreacting in 2011. So in that environment, in our base case, economies can glide towards trend. And essentially decelerate, but not see the economic cycle choked off. But again, recognizing that as a delicate balancing act. Now, there's a really positive tail risk scenario, which is that inflation proves to be more transitory than we think. And that means a peak in the first or second quarter. There are a few renegades out there among strategists that are predicting that's going to happen. God bless them, from their lips to God's ears. I don't think that's likely, but again, it is a possibility. And of course, that means growth could remain above potential for longer because central banks can turn more dovish. Now, then there is that alternate tail risk scenario that is much worse, and that is that high persistent inflation. Essentially, inflation expectations become unanchored because of higher inflation prints. And a lot of times it can become a self-fulfilling prophecy. And then, of course, developed market central banks feel that they must react to it in a very aggressive way. Now, some would argue we're already in that high persistent inflation scenario. And I would push back and say we're not. We won't know that really until it's in our rearview mirror. Although I do recognize that central banks feel that they need to at least be hawkish in their words, if not their deeds. And so we're seeing that coming from the Fed, we're seeing that coming from the ECB, and indeed we're seeing that coming from the Bank of England already on its second rate hike. So it's certainly, we're certainly flirting with this scenario, and there is concern that inflation is going to be persistently high. But again, I would argue that central banks know that there are there's a good portion of that inflation that they cannot solve for with policy, so that it's going to be more valuable to talk hawkish and perhaps surprise on the upside. Again, well, it remains to be seen. We'll see how that goes. If you turn to the next slide, so what looks good about inflation? Why are we positive? What are our issues? So clearly, we've had a perfect storm that has contributed to inflation, right? We have had higher demand because of elevated household savings, and the demand's been concentrated in goods as opposed to services because of the nature of the pandemic. Also, because of the nature of the pandemic, we've had very significant supply chain disruption. And so the normal supply-demand balances have not been present, right? And that's been a real issue. But what we do know, just a few key things, is that we have seen rotations into services. When the pandemic has essentially, when waves have dissipated in COVID. So I anticipate a more prolonged great rotation to services as the pandemic shifts to an endemic this year. So that should take some pressure off of goods. I also think that supply chain disruptions are improving. At least components of supply chain disruptions are improving. There are going to be issues that remain for a long time, like semiconductor chips, which I'll get into in a minute. But in general, I think the situation improves from here, but slowly. So what are the issues? I think wage growth. That is the stickier part of inflation. And so that's why I gave the caveat that I would expect inflation to peak and then gradually moderate, because wage growth is sticky. We know that. But I would also draw a distinction between wage growth in the retail sector, services, hospitality, travel, leisure, versus wage growth in other parts of the economy because of the level of employee turnover. It's a lot easier to essentially hit the reset button on wages if you have high levels of employee turnover, if labor force participation improves, which I would anticipate it does. So, for example, while we know that there are fast food restaurants that are offering $15, $16 an hour, starting bonuses, things of that nature, that can easily be changed if there's a more ample labor force that is willing to work there. So it's not as sticky as, say, wages in tech or financial services. So I do give that caveat. Again, this is not going to come down quickly, but to me, it will come down. And if we look at where wage growth is coming from, the highest levels of wage growth have been in that, actually the retail space, areas like travel and leisure, as well as in restaurants, as well as healthcare. So home health aides, area, that portion of it. Now, home health care aides, there's some turnover there, not as high, of course, as the retail space. But if you look at the ECI that came out last week, that's where the really significant wage growth has come from recently. So that could easily get dialed down, within 3 to 6 months, depending upon labor force participation. So if you turn to the next slide, in terms of goods, I talked a little bit about this already, that goods prices can fluctuate. Look at lumber this past spring. It went up and then it went down. And so what we're seeing is a lot of consumers holding off on big purchases, saying it's not a good time to buy. And to a certain extent, that can continue. So that certainly won't contribute to any kind of spiral in goods prices. So I think that's where we see costs come down the most rapidly. So if you turn to the next slide, it's the supply chain disruptions that are the real issue. And some of it is not necessarily resulting in a much bigger increase in prices, but it's causing delays, which means there's a supply-demand imbalance that ultimately causes the end product to have a higher cost. Those of us who have tried to buy a car in the last year have probably experienced that already. It's an issue for other items as well. So what's getting better and what isn't? Well, I don't think we're going to see much of a reduction right away in container costs. And those have been very significant for the route from Asia to the United States. I talked to a few different buyers for department stores to kind of get on the ground sources. And what they're telling me is that what used to cost pre-pandemic, a container cost $4,000, is now costing roughly $24,000 for a container. So how does that impact you? Well, if you're buying a small item like a doll, it's adding probably 25 cents to the cost of the item. But if, for example, you're buying a living room set, think about it, you could probably fit about 20 living room sets in a container. So that means that pre-pandemic, that would be about $200 per living room set. That would be, the cost essentially of the freight that would be added in. Now that's $1,200 per living room set. So that's not going to come down rapidly, especially since energy prices are higher, sourcing labor is higher. But there are other components that are likely to come down. For example, if we see an improvement in labor force participation, then the transport by trucks in the United States will improve. We'll see prices come down there. And I think that will come down as we move from pandemic to endemic. That has certainly been a contributing factor, not all of it, because we've had scarcity with truck drivers even prior to the pandemic, but it really exacerbated it. So it should slowly work itself out and cause a reduction in prices. But certainly the imports are likely to cost more than that which is produced in the United States. But certainly the situation is incrementally improving in general, and I think that's the most important part of it. And I should also draw the distinction in semis. The very sophisticated semiconductors, they're in good shape. For those of you who listen to the earnings call for Apple, you heard that they don't have real issues with their semiconductors, but it's not the case for less sophisticated semiconductors, where there have been issues really that go back pre-pandemic, because there hasn't been a lot of interest in investing in foundries for what are low margin chips that could become obsolete soon. So that'll and it's those less sophisticated chips that are going into things like cars. So that should be a continued problem for a while longer. But again, in general, the situation's improving. All right, on to the next slide, COVID-19. I talked about pandemic to endemic, and I think very much that is the case. We're seeing that, and vaccinations are helping. And by the way, Omicron, actually, while it was a short-term negative, should be a positive, because it has moved through countries rather quickly. And in EM countries, especially ones that have had disappointingly low vaccination levels, it can serve as a rather rapid immunizer. And so I think there's the potential that we actually have a higher level of immunity more quickly this year. But in general, this should start to fade into the background. That doesn't mean we won't have short-term issues with waves. Now we're hearing about a variant, an offshoot of Omicron that has an even higher contagiousness factor. But from our perspective, the worst case scenario is, of course, the emergence of a variant that is not protected against by existing vaccines. But that hasn't happened. And even if it were to, I think, first of all, pharma, biotech companies have gotten very good at pivoting and working on what can protect against the whatever variant has emerged. But in general, we've also learned how to essentially keep an economy going, even in the face of a wave of COVID. So if you turn to the last set of slides, we're on to asset class implications. And that really is so important to really consider where we go from here. And if you turn to the next slide, this is a really helpful rule of thumb in terms of what's worked in what portion of the economic cycle. So as I said, we're moving from expansion to slowdown. And that means growth is above trend, but it's decelerating. And this cycle can last a long time. Again, a lot of this depends upon what the Fed does this year. The ball is in the Fed's court. But I tend to be optimistic, and I tend to believe that the Fed will be able to manage and engineer a soft landing. So what does that mean? That means there's a convergence of asset classes, that we tend to see returns not very different. Equities certainly return a bit more than government bonds historically in this environment, in this phase of the cycle, but not that much. And government bonds tend to outperform high quality credit. Not a big difference in performance, but they tend to outperform. And again, a lot of this will depend upon how long the slowdown lasts, but my expectation would be that it would last through this year. It's a good rule of thumb. It doesn't mean that this is going to be the exact way it goes, of course, in every slowdown phase of the cycle, but I think it provides some helpful guidance. And of course, the Fed and the nature of its, the level of its aggressiveness will certainly play a role in this, as well as what's going on outside the United States. But we're left with some really, really significant challenges. In particular, where do you go within equities? And if you turn to the next slide, historically, there should be a slide, there should be two slides before that. Actually, if you keep going, maybe it's after it. I apologize if I screwed up the order. Well, actually, let me speak to it then. My apologies. I may have truncated this deck. But when we're looking for growth in a slow growth environment, we go to secular growth. We go to areas like technology, like healthcare, communication services, and that tends to be a defensive area for investing. Now, that goes against conventional wisdom, especially since we know that in a rising rate environment, the pressure tends to be on higher valuation stocks. I mean, we've seen that happen already, where tech has come under enormous pressure. Now, I would say that there are two very different kinds of tech. There are the smaller, more speculative tech names that really peaked probably in November and have experienced weakness since then. And then the fundamentally strong, big tech names that have, that have very solid, wide profit margins, and have, a significant history of growth, and they have growth potential. And that, to me, is an area to focus on within equities in this environment, is those secular growth names. Now, of course, the other issue is, where do we go to generate income? And while we certainly, as I said, in the slowdown phase, it's the sovereign debt, ironically, that has performed a little bit better than investment grade. I think both those areas are areas that of course, should be solid performers over the slowdown period. But we're in a very low rate environment with the potential for rates to go up significantly. And so where does that take us? Well, in my opinion, and I get that many of you all on this call, because you're insurance companies, banks, you have essentially a limited range of options, or at least for most of your portfolio, a limited range of options. To the extent that you can have exposure to floating rate, that you can have exposure to high yield. I think that certainly provides some level of diversification. I think even in Treasury inflation protected securities in this environment, as well as high quality municipals, make sense. I think it's really important to be very well diversified while trying to reach for additional yield. It, again, is a delicate balancing act, just as the Fed's tightening is a delicate balancing act. So I see that I've come to the end of my time. I wanted to leave some time for questions. So let me stop here and see what you may have to ask me.
Hey, thanks, Kristina. Great presentation. We do have a few questions here, so we can go through them quickly. We're getting close to the end of the time. But one question was whether there should be concerns about tension with Russia, Middle East, and how would that impact inflation and investments?
So it's going to be a real problem for Europe more than the U.S., but it will certainly, it could certainly have an impact on the U.S. You may have seen the expectations. Some strategists have come out and set price targets of $150 on oil. So it will add to short-term inflation if it comes to fruition, or if we get closer to what appears to be a full-scale war, or if we just see a significant increase in sanctions. All those things can lead to an increase in the price of oil, although I'm skeptical it would get up to $150. But, Europe is already feeling a lot of pain from energy prices. And so I think central banks recognize that there's not a lot they can do about issues like that. So I don't know if it's going to result in any kind of central bank response, especially since the Fed can be somewhat dismissive as, because it would be headline inflation, although we know that oil works itself into a lot, to other parts of the economy and inflation. So I do think it will have a short-term impact on inflation if we do see tensions rise, but nothing that would probably prompt the Fed to act.
Okay, great. Keeping with the same topic of international issues, what happens with China this year? Will tariffs be rolled back on Chinese goods? And then also, will the financial weakness of China drag down the global economy?
So I think it's a great question. I hold out hope that tariffs will slowly be rolled back. It is not a politically it's not an issue that the Biden administration wants to tackle. I think they would try to do it quietly and try to essentially make it seem as though they're throwing carrots out for some concessions that China has made. That's going to be hard to do, but I do believe there's an interest in rolling back tariffs. It makes sense given the inflationary environment we're in. It would certainly take some pressure off, but there's a lot of political pressure on the Biden administration to not appear China friendly. And so far, that has been a real obstacle. What we've heard most recently from the Biden administration is that they're putting it in the hands of the trade negotiator, who is a hardliner with China. So we'll see where it goes. But I do hold out hope that we could start seeing tariffs rolled back. But think of it as incremental, relatively low profile, and again, spun as something that is being given for concessions, even though I think it's unlikely that we get any real concessions from China.
Okay, thank you, Kristina.
Oh, and then China. And then the question on China.
The financial weakness of China.
I think actually China starts to reaccelerate by the middle of the year. And that's because there's a very important party Congress coming up this fall, the Communist Party Congress. This occurs once every 5 years, and this could very well be the moment when President Xi is put on the same level as, the sort of what are considered to be the great leaders of China. And so he and the Chinese policymakers are going to want to have a strong economy by the time that Congress meets this fall. And so we're already seeing PBOC, the only central bank that's actually getting more accommodative. We're seeing some fiscal stimulus. And I think if China wants it to be, it will be, and that we're likely to see a reacceleration in growth by the back half.
Okay, thank you. I hear from our members talking about the potential of a very rapidly rising rate environment, and then they think back also back to the late 70s, early 80s. Is stagflation a possibility, or is there any probability of stagflation environment this year?
the risk has certainly increased of a stagflationary environment. We still would assign it a pretty low probability, just because growth has been strong. Again, that's what the Fed is leaning on, that we've seen a very strong recovery, and the unemployment situation is so good. We're above trend right now, so we do not fit into the category of stagflation. But certainly if the Fed chokes off the economy enough this year, but is not able to combat inflation, because again, many of the forms of inflation we're seeing cannot be solved for by monetary policy. There is the risk that it happens. So we'll want to follow that closely. We'll want to look at our end of cycle dashboard. But as it stands right now, and based on my views on what Fed policy will be this year, I think we avoid stagflation and that it's a pretty low probability event.
Okay, thank you. Last question. What's your outlook on agency MBS in this environment?
That's a good question. Well, I think it's going to be a challenging environment for, it's a mixed picture for 2022 is probably the best way to categorize it. Supply is expected to decline amid higher interest rates. You've got Fed demand, of course, ending, and I think there are certainly some positives to owning it, but it is definitely a mixed picture for 2022.
Okay. Well, that concludes our webinar today. We really appreciate it, Kristina. Thanks again. Hopefully, maybe you could come back and do another session like this in the future. It was really great. And I hope everyone enjoyed
pleasure.
it. Excellent. And then thank you to all the members who joined us, and also guests who joined. So thanks for attending. And then also, if you could please fill out the survey at the end as you sign out. Those answers and that feedback really helps us out in designing some future educational programming. So with that, thank you, everyone. And thanks again, Kristina. And I'll see everyone again soon.
Thanks so much.